Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, let me introduce myself. My name is Diah Ramadhani with student number 2341 2060 from Class AKT 23A. In this video, I will present a topic that plays a central role in understanding how global business manage their financial statement, cash flow, and taxation in international financial management. As companies expand across borders, they face new challenges related to different accounting standards, fluctuating exchange rate, and complex tax system. There's three elements: financial reporting, cash flow management, and taxation are deeply interconnected and crucial for ensuring that multinational corporations can operate efficiently and profitably in a global environment. In this presentation, I will explain how these components function and why they are important for international financial decision making. Financial statement in an international context. Financial statements are the foundation for assessing a company's performance, profitability, and financial position. In an international context, preparing accurate financial statement becomes more complex because companies must comply with different accounting standards, such as International Financial Reporting Standard or IFRS and Generally Accepted Accounting Principle or GAAP. Multinational corporations often need to reconcile these differences to maintain consistency and transparency for global stakeholders. Moreover, fluctuation in exchange rate can significantly affect the value of assets, liabilities, revenue, and expense when compared to the reporting currency. To address this issue, multinational firms use foreign currency transaction methods to consolidate financial information from subsidiaries in different countries, ensuring that their reports accurately reflects overall financial health and performance. Cash flow management is international operational. Cash flow management is a vital aspect of international financial operation because it determines a company's ability to maintain liquidity and meet global financial obligations. Unlike domestic firms, multinational companies must deal with exchange rate volatility, currency restriction, and this differs a banking system in different countries. To overcome this challenge, corporations use techniques such as cash pooling, which consolidates cash from subsidiaries to improve liquidity management, and a netting system, which reduces the number of international transactions by offsetting payables and receivables between subsidiaries. Additionally, firms use hedging instruments like forward contract options and swaps to minimize the risk of currency fluctuation. Efficient cash flow management not only stabilizes operation but also reduces financing costs and exchange profitability in international markets. International taxation and its impact on financial decisions. Taxation is another crucial factor in international financial management, as it directly affects the after-tax profit of global operations. Multinational corporations must comply with multiple tax system, each with different rules, rate, and reporting requirements. One major issue they face is double taxation, where the same income is taxed in both the host one and home countries. To mitigate this, many nations have established a double tax treaties that provide tax credit or exemption to avoid such overlap. Companies also engage in international tax planning using strategies like transfer pricing, setting a price for transaction between subsidiaries to allocate profit efficiently across jurisdiction. However, this practice must strictly with international tax regulations to avoid penalties and reputational damage. Understanding international tax structure allows companies to plan their investment more strategically and maximize global returns. Integration between financial statement, cash flow, and taxation. In practice, financial statement, cash flow, and taxation are interconnected components of international financial management. Financial management provides essential data for analyzing cash inflows and outflows, while taxation directly influences both net income and available cash for reinvestment. For instance, before entering a new market, a multinational company must evaluate not only project revenue and costs, but also how local tax laws and gas repatriation restriction may impact profitability. Integrating this aspect enable management to make more informed and strategic financial decisions, manage risk effectively, and sustain long-term financial stability. Therefore, understanding the relationship among these three elements is key to achieving success in global financial operation. Application of financial statement, cash flow, and taxation in international business education. In the real world of international finance, understanding the relationship between financial statement, cash flow, and taxation is essential for making strategic business decisions. Multinational corporations rely on comparative financial analysis to evaluate subsidiaries operating under different currency and tax systems. For example, cash flow projections are used to indicate whether to expand production in a foreign country or to repatriate profits to the parent company. Meanwhile, tax consideration influence the choice of investment structure, transfer pricing policy, and dividend distribution strategy. By integrating accurate financial statement with effective cash flow management and tax planning, companies can optimize a global operation, reduce financial risk, and maximize after-tax returns. Thus, mastering these three financial elements enable managers to make informed and sustainability decisions in a complex international environment. Conclusion. In conclusion, financial statement, cash flow management, and taxation are the backbone of international financial management. Together, they provide the necessary framework for assessing performance, ensuring liquidity, and making sound strategic decisions in a complex global environment. Financial statements help evaluate results, cash flow management ensure the availability of funds, and taxation affect profitability and cross-border investment planning. By mastering these three elements, financial managers can strengthen other companies' competitive, maintain global compliance, and optimize long-term value creation for stakeholders. Thank you for your attention. That concludes my explanation. Thank you. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.